With the U.S. markets currently closed for the night, Opendoor Technologies, trading under the ticker OPEN, ended its last session on Tuesday, October 7, 2025, at a price of $9.29 per share. This represented a fractional gain of just over 0.03%, a move so small it barely registers on most trading platforms. But to dismiss this as a quiet day would be a fundamental misreading of the situation. That seemingly insignificant price action is not a sign of stability. It's the eerie calm at the center of a storm. It represents a market in perfect, tense equilibrium, holding its breath before the next violent move. What's really happening inside Opendoor stock is a brutal tug-of-war, not just between buyers and sellers, but between two completely opposing narratives about the future of real estate itself. This isn't a simple story of a tech company. It's a high-stakes wager on the very cost of money and the future of the American housing market. And that flat closing price is merely the momentary pause in a much larger conflict. The expectation, the story that propelled Opendoor to incredible heights and attracted a legion of hopefuls managing their own portfolios through platforms like Robinhood or SoFi Invest, was incredibly compelling. It was a narrative of disruption. Opendoor was positioned as the inevitable future, the Amazon of real estate. The traditional process of selling a home, with its endless showings, uncertain timelines, and hefty agent commissions, was presented as an archaic relic. Opendoor offered a sleek, tech-driven alternative. Get a cash offer in minutes, close on your own timeline, and skip the hassle. For many, this was the ultimate application of technology to one of the largest, most inefficient asset classes in the world. Investors envisioned a future where Opendoor's algorithms, fed by vast amounts of data, would perfect the art of pricing homes, creating a liquid, streamlined marketplace. The belief was that this was a software company with near-limitless scaling potential, not unlike the early days of other transformative tech giants. This was supposed to be a pure growth play, an investment in a new paradigm for how people transact their most valuable asset. The thinking was that if you were comfortable with the volatility of a Tesla stock or the forward-looking valuation of an Nvidia stock, then Opendoor was the logical next step in a modern portfolio. However, the reality that has unfolded is far more complex and sobering, a truth that institutional traders on platforms like Interactive Brokers have been pricing in for months. The hard reality is that Opendoor is not a pure-play technology company. It is, at its core, a capital-intensive real estate holding company that uses a technology platform as its front door. Unlike a software business with high margins and low physical overhead, Opendoor's balance sheet is laden with billions of dollars in tangible, illiquid assets, single-family homes. This exposes it directly and brutally to the cyclical nature of the housing market. Its entire business model is a spread game, dependent on buying low and selling slightly higher multiplied by thousands of transactions. This model thrives when interest rates are low and home prices are steadily appreciating. But when that macroeconomic tide turns, as it has, the model comes under excruciating pressure. The data advantage that was once celebrated proved painfully fallible when the market shifted, forcing the company into massive inventory write-downs. Its profitability isn't a function of user growth or subscription fees, it's a direct function of mortgage rates, housing inventory levels, and the cost of the corporate debt required to fund its operations. This isn't the clean, high-margin world of software, it's the gritty, low-margin, high-risk world of a market maker for one of the world's most volatile assets. This is the kind of detail that requires more than just a glance at a stock chart. It requires a deeper level of investment help and understanding. The recent trading activity in Opendoor stock tells this story of conflict in vivid detail. The stock has been trapped in a range, showing significant resistance every time it tries to push past key psychological levels. Volume analysis reveals a fascinating pattern. Trading volume remains relatively anemic on company-specific news, but explodes on days with major macroeconomic data releases, like the Consumer Price Index or statements from the Federal Reserve. This tells you everything you need to know. The market is not trading Opendoor on its own merits. It is trading it as a leveraged bet on interest rate policy. This is not the behavior of a stock with a clear, independent growth trajectory. It is the behavior of a financial instrument tethered to the whims of central banking. Institutional ownership reports, a key metric for those using sophisticated brokerage tools from Fidelity or Interactive Brokers, show a divided house. While some value-oriented funds may be nibbling at the edges, seeing a beaten-down asset, many growth-focused institutions have trimmed their positions, unwilling to take on the macroeconomic risk. The options market is pricing in significant volatility, with both call and put volumes elevated, suggesting that traders are preparing for a major price swing but are completely divided on the direction. This isn't an investment for a passive, set-it-and-forget-it approach you might find with Schwab Intelligent portfolios. It's an active trader's battleground where conviction is low and uncertainty is high. To be clear about what the company does, Opendoor is the pioneer of the iBuying, or instant buying. A homeowner can go to Opendoor's website, enter their address, and receive a preliminary cash offer for their property within a day. If they accept, Opendoor conducts an assessment and then buys the home directly. The company makes minor repairs and then lists the home on the open market, aiming to sell it for a profit. Its revenue comes from a service fee, typically around 5%, which it argues is competitive with traditional agent commissions when all is said and done. But its primary cost and its primary risk is the value of the home itself. During the boom times, this model looked foolproof, as appreciating home values provided a natural tailwind. But the period following the aggressive rate hikes served as a brutal stress test. The company was caught holding thousands of homes that were rapidly losing value, forcing it to sell at significant losses to clear its inventory. This historical lesson is a critical lesson, a stark reminder that even the most sophisticated algorithm can be overwhelmed by a tidal wave of macroeconomic change. For anyone doing their own self-investing, understanding this recent history is non-negotiable. Looking ahead, the future of Opendoor stock hinges on a few critical factors, creating wildly divergent potential scenarios. The bull case is straightforward and entirely dependent on a favorable macroeconomic shift. If the Federal Reserve begins a sustained cycle of cutting interest rates, leading to a significant drop in 30-year mortgage rates, the housing market could see a resurgence in activity. Lower rates would not only increase demand from homebuyers, making it easier for Opendoor to sell its inventory, but it would also lower the company's own borrowing costs, directly improving its contribution margin on each transaction. In this scenario, with increased volume and healthier margins, Opendoor could finally demonstrate the scalability and profitability that its early backers envisioned. The path to sustained positive cash flow would become clear, and the stock could re-rate significantly higher. Conversely, the bear case is an extension of the current reality. If inflation remains stubborn and interest rates stay higher for longer, the housing market will likely remain in a state of gridlock. High mortgage rates would continue to suppress affordability, keeping transaction volumes low and putting constant downward pressure on home prices in many regions. For Opendoor, this means a difficult selling environment, longer holding times for its inventory, and continued pressure on its margins. Another leg down in housing prices nationally could trigger another round of painful inventory write-downs, further damaging its balance sheet and investor confidence. The risk is that the company becomes caught in a prolonged period of stagnation, burning through cash while waiting for a macroeconomic environment that may not arrive for years. Comment below what you think the average 30-year mortgage rate will be by this time next year. Do you think it will be high enough to keep pressure on Opendoor stock? This is the central question that will determine whether an investment in this name through an individual brokerage account proves fruitful or frustrating. The apathetic price action of today is simply the market waiting for an answer to that very question. In summary, the story of Opendoor Technologies is a classic case of expectation versus reality. The expectation was that of a disruptive technology firm, a software-like business set to dominate a massive, antiquated industry. Investors who jumped in using accessible investing sites and apps saw a clear path to exponential growth. The reality is that Opendoor is a capital-heavy real estate company, inextricably linked to the housing cycle and beholden to interest rate policy. Its recent stock performance, culminating in the quiet close at $9.29, isn't a sign of newfound